Dinshaw Irani joins us on the show today. Dinshaw, hi, good afternoon. Good to have you on the show. What is it that you're making? Life after 50 bips cut? What does it spell for India?
Aisha, thank you for having me on your show, and a very good afternoon to you and your viewers. So basically, history repeats. Every time there's been a rate cut, uh, you've seen a fall off of the markets. I think it's basically sell on news, which happens. But I don't think this time around, I feel it's a bit different. It's different because the cuts are happening into the strength of the economy. I mean, there obviously unemployment all is picking up there, but the fact is that the economy is not in a recession. I think what the takeaway is that the last time the Fed has done these kind of 50 bip hikes, I mean, rather cuts, when they started off their cutting season with 50 bips itself, I think it's been three times earlier. And all the three times it led to a very big recession because they were fighting a demon at that point in time. But today is not that time. I mean, it's very different from what's happening here. However, having said that, I think the biggest beneficiary would be obviously the rate sensitive like emerging markets, where as and when this cuts gets built in. So you will see flows coming back to India, or they already are happening, but I think that'll continue.
Flows will continue, and yes, that 50 basis point cut, but there are a lot of arguments to suggest that, of course, it's not a situation that we saw in 2007 when there was that 50 basis point cut, but I guess recession is something which only time will tell us. But the other big talking point, Dinshaw, is the fact the underperformance of the broader markets. Do you think finally they're getting undone, and this is that valuation scare that all of you guys were flagging out earlier, that they have run up quite a bit?
Actually, you're right, because I mean, we've been always pointing out that the mid caps itself looked very overpriced. I mean, the last I saw, the premiums to large caps was standing at close to 80%, which history, if you look at the last 10 years, even the history, the average is around 20 odd percent. If you take away this present blip as such, it was 20 odd percent. So this kind of an overvaluation would have sustained. That was what our feel was. And obviously, I mean, the fundamentals of the didn't kick in to that extent. Normally, they have a delta of 5, 7, 10% over the large caps in terms of earnings growth. But the last two quarters have seen that delta shrink quite appreciably. In fact, in the last quarter of June reported quarter, it was a negative delta to the large cap earnings. So it was a matter of time before this seeps in. But I actually am not that sure whether this will be our best case scenario. Actually, was supposed to be a time correction. Well, the price correction, it always helps in the sense that you will see those remaining on the sidelines coming back into the markets as such.
So, Dinshaw, in your own funds, have you eased off from any specific small and mid caps, either sectors or, select category stocks?
Actually, we've always been comfortable with small caps because the premium, I mean, normally the small caps trade at 10% discount to large caps. But we saw in the last 10 years, I mean, this is 10-year averages, but if you see the recent run, they're more almost at par to the large caps. In certain cases, there were certain discounts happening to the large caps. So we were never that uncomfortable with the small cap space. And frankly, I mean, small caps are anything beyond 250 shares is small caps. The top 250 shares is small caps. So we had always a good option of selecting from a wide variety of picks from here. So small caps we've not eased off. We did ease off a bit on the mid cap space. But looking at the fall today, I think I wish we would have missed eased off a bit more. But anyway, that's how life is.
Okay, so that's the take coming in. But, telecom as a sector is the, thing to talk about today. Of course, we have seen that negative reaction coming in on the Supreme Court verdict. So, Vodafone Idea is down 18%. Indus Towers is down 10%. Is it time now, Dinshaw, to perhaps start allocating some funds because the risk reward of value is there on the table, or not at all? This is not something that one should invest in, or maybe just some part of portfolio as a punt?
So basically, in pure telecom play, there was only one stock which was available, which is, I mean, Bharti. We were never convinced on Voda idea, and I mean, given the kind of debt the fellow was carrying, and obviously the liabilities, the forward liabilities that he had to undertake. And I frankly, I mean, looking at the past also, we weren't too we want to hopeful that something positive will come out from the AGR case as such, and that's what transpired, I suppose. And I think the stock is back at the level at which it started as going. I mean, in the past. So, frankly, I mean, I think Bharti stands out in this as a pure telecom play, obviously, and given the kind of strength that the stock has, in the sense the business has, in terms of the broadband mix and the postpaid customer mix and stuff like that. I think it's a stock to hold for a while. We already have it in our portfolio, so I can disclose that we're fairly bullish on that stock.
Right. Dinshaw, specifically, I want to pick up the point on PSUs, because while a large part of consolidation correction also played out, but that was very restrictive to a few cluster of stocks. I mean, HAL, some of the other defense names never moved anywhere. In fact, kept on clocking fresh highs, right? Today, perhaps you're seeing accelerated selling, and I can say that about PFC REC as well. There's HAL, BEL, all these stocks down. Would you say that now will begin that leg of correction?
Even the oil and gas companies, Aisha, I think you're missing those out as such, I suppose. But anyway, yeah. So basically, we going into the budget itself, we took a call that PSUs looked fairly overpriced. I think the budget was a non-event for PSUs. Frankly, I mean, if anything, it was slightly negative given that they had cut off on defense spends and stuff like that. So it was obvious that, and for some reason, the PSUs kept moving up despite the kind of budget that came out. But we never did add to that position. We, in fact, we even in the defense space, we chopped up a bit. And that's how it has been. We've been moving out of PSU space for a while. I don't think going forward, unless something dramatic happens, in the sense sell-off happens, sell-off as in the divestment happens in the case of PSUs, I don't think there'll be any positive triggers today for that space per se.
Lack of triggers as far as the PSU basket is concerned. But before we let you go, your view on financials, especially the large cap private banks, what within that looks the most interesting to you? Is it the underperformer HDFC Bank? Is it the consistent ICICI Bank?
Actually, you can see that smile on my face. We've always been bullish on banks, and for some reason, the banking space never performed, thanks to, I think, the crunch on liquidity in the system. And all along, we've been saying that once the interest rate cuts happen, I think the bank space will be a very interesting space to watch. And we're hoping that RBI will infuse some liquidity back into the system as such. So, frankly, I mean, I don't... PSU space, obviously, we are not that comfortable. Private sector banks, again, we've been fairly bullish, and whatever names you've taken are there in our portfolio plus more, and we continue to be bullish on that space. And frankly, I mean, if you're talking about the economy growing the way it is expected to for our country, this space is going to do wonders.
Okay, Dinshaw, always good to chat with you. Thank you so much for your time.
Always a pleasure, Aisha. Thank you.
If you like this video, then like, share and subscribe to ET Now.